Most people think Warren Buffett's rules only work if you're already rich. But the truth is, these first two rules matter more when you're average, stressed, and paid monthly. Rule number 1. Never lose money before you try to make it. Buffett's most famous rule isn't about investing. It's about survival. In real life, losing money rarely happens in dramatic crashes. It happens slowly through bad car loans, through high-interest credit cards, through, I'll figure it out later, spending. Imagine a 28-year-old professional in the U.S. earning $4,800 after tax. Rent is $1,700. Car payment is $620. Credit cards take $450. They're not broke because income is low. They're broke because fixed losses eat the future before it starts. Buffett avoids permanent loss at all costs, not volatility, not boredom. Permanent damage. Real-life application in 2026. Before investing a single dollar, eliminate guaranteed losses. High-interest debt is a guaranteed negative return. Paying 22% interest is the same as losing 22% annually. How to test this rule? List every expense that forces you to pay regardless of income. If that number grows faster than your skills or salaried, you're breaking rule number 1. Rule number 2. Stay inside your circle of competence. Buffett doesn't invest in things he doesn't understand. That's not humility. That's discipline. In 2026, people lose money, not because markets are risky, but because they invest in stories instead of understanding crypto. They can't explain. Startups, they can't value. Options, strategies, they copied from a reel. A European freelancer earning 3,200 euros per month puts money into AI stocks. They don't know how the company makes profit. They don't know competitors. They don't know valuation. They're not investing. They're hoping. Buffett only expands his circle when knowledge expands. Slowly, deliberately. Real-life application in 2026. Your circle might be simple. Broad index funds. Your own business. A skill that increases income. That's not boring. That's intelligent. How to test this rule? If you can't explain why you own something in 1 minute without using buzzwords, it doesn't belong in your portfolio. Part 1. Close. These are 2 rules. Aren't flashy. They don't promise fast wealth. They quietly prevent financial collapse. And that's exactly why most people ignore them. Once you stop losing money and stop pretending to understand everything, the next problem appears. Impatience. Buffett became wealthy not by moving fast, but by waiting, while others rushed. Rule number 3. Be patient. Money grows when you do nothing. Most people in 2026 feel broke even when they're not. Why? Because their money is always moving. Trading, switching strategies, chasing trends. Buffett's edge is inactivity. A U.S.-based employee invests $500 per month into an S&P 500 index fund. No timing. No switching. No panic. After 10 years, consistency beats almost every smart strategy. Meanwhile, another investor with the same income jumps between ETFs, crypto cycles, and news-driven trades. Their returns aren't terrible, but taxes, fees, and emotional decisions eat the advantage. Buffett understands that time, not intelligence, creates wealth. Real-life application in 2026. Markets are louder than ever, Algorithms move prices. Social media magnifies fear. Your advantage is silence. How to test this rule? If you feel the urge to check your portfolio daily, you're not investing. You're babysitting anxiety. Long-term investments should be boring. Rule number 4. Don't time the market. Time in the market wins. People still believe they can wait for the crash. Buffett doesn't. He accepts uncertainty as the cost of entry. A European couple delayed investing from 2021 to 2024 waiting for clarity. Inflation quietly reduced their savings by double digits. When they finally invested, prices were higher than when they first hesitated. Buffett buys when opportunities appear, not when fear disappears. Waiting for perfect timing usually means missing compound growth. Real-life application. In 2026, if your income is stable, start now. Small amounts, regular intervals. You don't need confidence. You need consistency. How to test this rule? Ask yourself, if markets go up 20% next year, would I regret waiting? If yes, you already have your answer. By now, you've noticed something uncomfortable. None of Buffett's rules require genius. They require restraint, and that's where most people fail. Rule number 5. Live below your means. Permanently, Buffett still lives in the same house he bought decades ago. Not because he has to, because lifestyle inflation is a silent wealth killer. In 2026, income rises faster than discipline. A software engineer in the U.S. earns $110,000 a year after tax, around $6,500 per month. New car, bigger apartment, more subscriptions. Savings stay flat. From the outside, they look successful. From the inside, they're one layoff away from panic. Buffett understands that wealth is what you don't spend. Real-life application in 2026. Live like your income might disappear, even when it won't. That margin is freedom. How to test this rule? If your expenses rise automatically after every raise, you're consuming your future self's safety. Rule number 6. Avoid debt that doesn't pay you back. Buffett is not anti-debt. He's anti-stupid debt. In 2026, debt is marketed as convenience. Buy now, pay later. Upgrade today. A European student finances gadgets, travel, and lifestyle on credit. The interest compounds faster than their career. Contrast that with productive debt. Education that increases income. A business that generates cash flow. Buffett only uses leverage when the odds are overwhelmingly in his favor. Most people use debt to impress people who won't help them later. Real-life application in 2026. If the debt doesn't increase income or reduce long-term costs, it's stealing from tomorrow. How to test this rule? Ask one question before borrowing. Will this make me more money or cost me more money? If the answer isn't clear, walk away. Up to now, every rule has sounded reasonable. This one feels uncomfortable because rule number 7 directly challenges how modern society measures success. Rule number 7, ignore the crowd, especially when it feels safe. This is the rule most people ignore. Not because it's hard to understand, but because it's socially expensive. In 2026, safety looks like following the crowd. Same investments, same lifestyle, same financial opinions. A U.S. office worker sees co-workers buying expensive homes at peak prices. Interest rates are high. Maintenance costs are rising. They feel behind, so they stretch their budget. Buffett does the opposite. He becomes cautious when optimism is high and interested when fear dominates. He doesn't need social approval. He needs favorable odds. Real-life application in 2026. If everyone around you agrees on a sure thing, risk is already How to test this rule? Ask yourself, am I doing this because it makes sense or because I don't want to feel left out? If it's the second, pause. Rule number 8. Price is what you pay. Value is what you get. Buffett never confuses popularity with value. In 2026, many assets are expensive. Not because they're great, but because they're trendy. A European investor buys a well-known stock at record highs. The business is solid, but expectations are unrealistic. Even a good company can be a bad investment at the wrong price. Buffett waits for a margin of safety. He doesn't chase excitement. Real-life application in 2026. Value applies beyond stocks, housing, education, cars. Paying top price removes your margin for error. How to test this rule? Before buying anything expensive, ask, if this loses 30% of its value, can I still sleep? If not, it's overpriced for you. B. T's point 1 pattern should be obvious. Buffett doesn't win by being faster. He wins by being longer term than everyone else. That's what the final 2 rules are about. Rule number 9. Reinvest before you reward yourself. Most people treat money as something to spend first and save later. Buffett does the opposite. He lets capital compound before it funds lifestyle. A young professional in Europe earns 3,800 euros per month. They invest 700 euros automatically on payday. What's left determines their lifestyle. Contrast that with someone who spends freely and invests whatever remains. There is usually nothing left. Buffett understands that reinvestment creates future choice. Real-life application in 2026. Automation beats motivation. If investing depends on willpower, it will fail. How to test this rule? If your investing happens only in good months, you're prioritizing comfort over compound. Rule number 10. Think in decades, not years. This is Buffett's greatest advantage. He's not optimizing for next year. He's optimizing for the rest of his life. In 2026, people want results in months. Side hustles, fast flips, quick exits. A U.S. investor sells solid holdings after 2 slow years. They miss the next decade of growth. Buffett allows time to do the heavy lifting. He knows that short-term volatility is the entry fee for long-term wealth. Real-life application in 2026. Your financial decisions should survive boredom, fear, and slow progress. How to test this rule? Ask yourself, would I still be happy with this decision if nothing exciting happens for 5 years? If not, it's speculation, not investment.